Thank you so much for clicking on this video. This is video number 3 in a 4-part series to get you excited about the upcoming SSP virtual conference, February 23rd through the 25th. Information on how to register and attend the conference is above us on this video. Today, we are attacking a problem that's been around for a while, and that is the double taxation of attorney fees on taxable cases. So today we have Larry, who's the point person on Eastern Point Trust Company's solution to solve this problem. And we also have Jeremy Babener, who all of you know at SSP, who's been working in conjunction with Eastern Point on this solution. So Larry, why don't you say hello?
Good morning.
Hi,
Meet you all.
Absolutely. So Jeremy, this is a problem that's been around for a while. It's been ignored. They've had other solutions that have attempted to work, such as the lawyer owning the claim. They've tried to rely on rulings that aren't applicable, such as a charity deduction. Why don't you walk through what you are doing with Eastern Point to solve this problem?
Yeah, and I'll bring up the screen there. But yeah, this has been a problem for quite some time. We used to talk about it as the alternative minimum tax limiting plaintiffs' ability to deduct legal fees in taxable cases. And that will be a problem again, but at least for now and for the next several years, and started in 2018, new law was passed that actually limits the ability to deduct legal fees in taxable cases in almost all cases. With a couple exceptions. Before diving too far in, just to kind of give everybody an idea of the size of the problem, and when you solve the problem, it's the size of the benefit that you get from, in this case, from the solution. In this case, the plaintiff recovery trust. So, what happens when you are facing this problem and you're able to get out of it? And it depends by tax rate, because the higher the tax rate, the bigger the problem, and so the bigger benefit the solution. If you're at a 35% tax rate, which is probably the lowest you're going to get in a taxable case of any real size, more than a couple hundred thousand, the solution will actually increase the net after-tax recovery to the plaintiff by almost 50%. And the higher the tax rate you go, the bigger the benefit you're actually going to obtain. So let's talk about the problem itself. I've called it the plaintiff double tax, but in short, the concept is, if you're not able to deduct your legal fees, then let's take a $10 case or a $10 million case that's taxable. The plaintiff gets to keep $6 and pays $4 of that to the attorney. The problem is that they're taxed on the $6 and on the $4, and of course then the attorney is taxed on the $4 as well. So you end up getting those same dollars end up getting taxed twice, hence the double tax. And unfortunately, another way to look at it, and often the way a plaintiff will look at it, is that it really increases the cost of the lawyer's contingent fee. Because when you think about it, if the lawyer is getting 40% and the plaintiff is taxed on 40% of the 40%, let's say because they're being taxed at a 40% tax rate, well, 40% of 40% is 16%. So all of a sudden, the legal fee that you thought was a 40% contingent fee is really a 56% contingent fee. And now you only have 44% left to structure, left for the plaintiff. And of course, some of that 44% is going to be paid out in taxes on the plaintiffs, on the amount that the plaintiff gets to keep. So let's take a look at the actual effect on the net after-tax recovery, because of course that 44%, some of that's about to go to taxes. Well, the math is pretty easy. If 40% goes to the lawyer and 40% is paid in taxes on the total, that takes us down to 20%. And most of you are familiar with this in taxable cases. Again, the tax rate is going to govern quite a bit here. Here we're assuming a 40% tax rate. But if you're at a 35, 37% tax rate, a lot of states are taxing, state and local, put it together and you've got 8, 10, 15%. So 40% is a pretty low, a low tax rate in a large taxable case. And you can see here on this graph, the higher the tax rate, here we go all the way up to 60%, higher the tax rate, the less the plaintiff gets to keep. And here you can see that marker there of the 40% tax rate on $1 million case, you get to keep 200,000, not a lot. So let's look at the solution, because that right there is the problem. So Eastern Point is calling it the Plaintiff Recovery Trust. And in short, what's going on is that the plaintiff will contribute their claim, their right to receive money for their injuries. They'll contribute it into the recovery trust. Then when the recovery trust pursues that claim, settles the claim or receives an award, the recovery will be received by the trust. The trust can then pay the fees and distribute the remainder to the plaintiff. In this way, the plaintiff never receives, for tax purposes, never receives anything beyond the remainder, and most importantly, those fees. So Eastern Point ended up partnering with the fairly large law firm Fager Drinker, some of you know it as Drinker Biddle, on the form of the recovery trust. Now, if you don't know Eastern Point, I know most of you do, but you'll know they handle a lot of the biggest cases, QSFs, settlement recoveries, and so forth. They also handle a number of other types of trusts. Fager Drinker, they actually provided not only a tax opinion, which we can share under an NDA, but they also provided a short form opinion, which you see here, and we can share that. On top of that, they have offered that any plaintiff using the recovery trust, they will issue that plaintiff a tax opinion for a flat fee of, I think, about $4,000. So kind of set everything up so that everyone can be comfortable with the arrangement. So let's talk a little bit about results. Chris, you and I were talking about this before. So in short, you'll recognize that the graph on the left, there's 20% left. But with the recovery trust, in the same 40% tax rate, you end up recovering a net after-tax recovery of 34%. Now, it's all about the way you present it to the plaintiff, right? Because the difference between 20 and 34% might not seem huge, but if they really look at it as, well, they could get 20%, and now you're literally increasing the amount that they keep by 70%. And of course, the higher the tax rate, the larger the benefit. And here you can see that same blue graph with the diminishing returns in a typical case. In a recovery trust case, they'll end up keeping significantly more. So at a 40% tax rate, they're actually keeping an extra $140,000. Of course, as you get closer and closer to 50 and 60%, there's almost nothing left in a typical case. But with the recovery trust, you're maintaining that net recovery. Obviously, fees, very relevant. Fortunately, Eastern Point has offered to charge fees based on the tax savings themselves. So they'll charge 20% fee, or a fee equal to 20% of the tax savings. Why don't we talk a little bit about cases that this is relevant for? It's not for every case. Number one to know is it's for taxable cases. So if you have a tax-free case that has punitive damages, now this is very relevant. The typical minimum is about $500,000 of taxable damages. Eastern Point will take less, but then they'll charge a minimum fee. But outside of the tax-free cases, emotional distress cases, alimony fraud, not a lot of folks in the SSP are working on professional malpractice cases, defamation cases, and things like that. But the attorneys you work with this would be relevant to them. When you don't need it is, like I said, a tax-free case. And also if the plaintiff is a business, so they can deduct the legal fees as a business expense, you don't need it. a lot of employment cases and some discrimination cases. Again, there's an exception in the rule that allows you to deduct those legal fees, in which case you won't need it. Anytime you're not sure, we'll give you the contact information. If you call Larry, he'll walk you through whether your case will benefit, and can even talk about the specific value of that benefit. Then structured settlements. On the investment side, goal is this should change nothing. We've already been in touch with the various providers of non-qualifieds as well as some qualifieds, and we've received confirmation from multiple of them, and we've already received tentative confirmation from the others. So at the end of the day, what will happen, the only difference will be that when you enter into the settlement agreement and the assignment agreement, the recovery trust will be acting as the plaintiff. And when the structured settlement annuity is purchased, the payee will be the individual, your client, the injured individual. This also works for post-QSF as well as for structured fees. Chris already talked a little bit about the things that don't work, so I'll jump past that. And that kind of takes care of it. Glad to talk through any questions when we're in the conference. Larry's available for any questions on specific cases. I'm glad to jump in as well.
So at a high level, SSP members should know that this solution increases the recovery for the plaintiff and allows for either more money to be structured or more money to be put in the pocket of the plaintiff, correct?
Absolutely, absolutely. Oh, see, this is the missing mind of the tax lawyer. Of course, we didn't talk about compensation as well. Eastern Point offers, obviously the fee is not as substantial, but the fee charges 20% of the tax savings, and they'll pay a referral fee to brokers and advisors of 10% of that amount. So it's a 10% referral fee.
All right. So thank you, Jeremy. Thank you, Larry. If you have a case that you think might need this type of assistance, encourage you to reach out to Larry or Jeremy, and they'll, I'm sure, provide excellent service and get you all the answers that you need. So remember to register for the upcoming SSP conference, February 23rd through the 25th. And thanks so much, guys, again. Take care.
Thank you.